All right, let's jump right into this explainer and demystify a pretty fascinating corner of the financial world. Today, we're exploring the massive wealth creation potential of small caps and juxtaposing that against the frankly terrifying reality of market volatility. If you've ever wondered how some investors manage to multiply their capital exponentially, we're talking 10 or 20 times over, while others just get completely shaken out during market dips, while you're in exactly the right place. We're going to look specifically at the mechanics of the HDFC Small Cap Fund to understand exactly how this engine works. Here is our roadmap for today. 1. What are small cap funds? 2. Meet the HDFC Small Cap Fund. 3. Performance, fund versus benchmark. 4. Comparing peer mutual funds. 5. Decoding the risk metrics. And 6. Takeaways for new investors.
All right, part 1. What exactly are small cap funds?
So when we talk about the small cap universe, small definitely doesn't mean a mom-and-pop shop on the local corner. By regulatory definition, specifically from SEBI in India, a small cap mutual fund actually has to invest a minimum of 65% of its total assets into companies ranked 251st and below by market capitalization. These are often scrappy, early-stage, highly niche businesses. Think regional champions, specialized manufacturers, or emerging sector leaders that just haven't hit the mainstream institutional radar yet. They're massively under-researched, which means there's a huge opportunity for price discovery. And honestly, this highlights the ultimate core trade-off of investing. On one side of the ring, you have large caps, the top 100 companies. These are your stable, established giants offering reliable but moderate growth. On the other side, small caps. Yes, you're absolutely going to see higher volatility. But think about the math for a second. It is infinitely easier for a company valued at 500 crore to grow into a 10,000 crore powerhouse than it is for a massive sprawling conglomerate to suddenly multiply its size. That's a 20x wealth creation journey right there. You're basically accepting sharp, sometimes scary drawdowns for the very real possibility of compounding at rates large caps simply can't match. Moving to part 2, let's meet the HDFC Small Cap Fund. 40,417 crore rupees. To put that into perspective, this staggering number represents the fund's assets under management, or AUM, as of July 2026. Managing a capital pool of this incredible scale gives them some distinct structural advantages, like unmatched corporate access and incredibly broad diversification. But it's a double-edged sword. It also presents serious operational challenges, especially regarding liquidity. Basically, how fast they can buy or sell these smaller companies without accidentally disrupting the market price. Now, you'd probably think a fund this mammoth would be forced to cheat a bit, maybe buy mid or large cap stocks just to park all that cash safely. But looking at their market cap distribution, they remain remarkably true to label. Over the last 5 years, they've maintained an average of about 80% exposure strictly to small caps. Actually, their weighted average market cap is significantly lower than the category average. They are genuinely fishing in the small cap pond, no shortcuts. And here is where they build a distinct edge over the rest of the pack. They operate on a strict value philosophy, meaning they just flat out refuse to overpay for momentum. Second, talk about conviction. The data shows over 50% of their assets are held for more than 5 years. They aren't day trading, they are partnering with these businesses. They also mitigate risk through deep diversification, holding anywhere between 83 and 86 stocks, while strictly capping any single stock at a maximum of 4% of the portfolio. Finally, they're actively targeting sectors that large caps usually ignore, like auto components, healthcare, and knowledge process outsourcing.
Section 3. Performance. Fund versus benchmark.
Okay, in the spirit of radical transparency, look closely at that 1-year mark. Notice how their very strict value discipline has actually caused a recent 1-year underperformance. They are sitting in the red at a negative 1.65%, while the benchmark is at a positive 1.18%. But pull your lens back and look down at the 5-year and 10-year horizons. This is exactly where the strategy shines with stellar consistency. Over 10 years, they're delivering around 18.4 to 20.6%, solidly beating both the benchmark and the category average. As they say, it's a marathon, not a sprint. Which brings us to Section 4, comparing peer mutual funds. Contrasting this against major peer funds, it's clear that momentum-driven competitors have had a much better run in this recent 1 to 3 year window. Funds like Quant and DSP are posting 8+% returns over the last year, while HDFC is temporarily playing catch-up. So naturally, this leads us to ask a pretty vital question. Why does HDFC behave this way? Why are they lagging behind the pack right now? To answer that, we jump into Section 5, decoding the risk metrics.
Let's start with standard deviation. Now, technically, this indicates how widely a portfolio's returns vary from its historical mean. But honestly, I just want you to think of it as the overall bounciness of the fund. HDFC's standard deviation sits at 17.87%. The category average is higher, sitting at 19.86%. What does this prove? It shows HDFC is deliberately engineering a slightly smoother, less chaotic ride for conservative investors, even if it means missing out on the absolute wildest short-term peaks. For a beginner assessing long-term capital growth, knowing this metric is crucial to figuring out if you'll actually have the stomach to hold the fund long-term.
Next up is portfolio beta. This is a massive risk-reward measurement that shows sensitivity to broad market changes. Imagine the market benchmark is exactly a 1.0. If a fund has a beta of 2.0, it shoots up twice as fast, but man, it falls twice as hard, triggering immediate investor panic. HDFC has a beta of just 0.78. This means it is significantly less sensitive to broad market crashes than a standard index tracker. It is built defensively from the ground up.
Then we have alpha, which measures the fund manager's active value add relative to the benchmark. Right now, HDFC is sitting at a negative 2.22% alpha for the 3-year horizon. And yeah, that directly reflects the recent lag behind the benchmark we saw a minute ago. But here is the secret. Veteran long-term investors often accept periods of negative short-term alpha because they deeply value the capital protection and value discipline this specific manager provides when the rest of the market gets dangerously overheated.
Okay, let's talk about capture ratios, because this right here is an incredible asymmetrical advantage. When the market is booming, HDFC captures 90% of those gains, but when the market falls, it only suffers 74% of the pain. Think about that. You are participating in almost all of the party, but suffering far less of the hangover. This is exactly why slightly conservative investors love this fund. All of this defensive posturing basically boils down to one single metric, the price-to-earnings or PE ratio. The benchmark index is currently trading at a highly elevated PE of around 37.60. Meanwhile, HDFC's portfolio is sitting pretty at just 21.24. This dramatically lower PE ratio acts as a massive margin of safety. It visually proves that the fund manager flat out refuses to overpay for stocks, even when everyone else in the market is running hot and chasing momentum.
Finally, Section 6. Takeaways for new investors.
So how do we actually use all this data? If you're a new, maybe slightly conservative investor looking at small caps, here is your non-negotiable playbook. First, mentally prepare for 20 to 40% temporary drawdowns. It's a feature of this market, not a bug. Second, you absolutely must use SIPs, systematic investment plans, to automate your buying and navigate that volatility through rupee cost averaging. Third, do not touch this money for at least 7 to 10 years. And finally, treat this as a satellite holding. Cap it at roughly 5 to 15% of your total portfolio and balance it out with stable large caps. By understanding the lower beta and the defensive PE metrics we just discussed, beginners can confidently set these long-term expectations without panicking at the first sign of a drop. The source data we've unpacked today makes one thing incredibly clear. The massive 20x wealth creation of small caps is genuinely there for the taking. But it demands a toll. It requires the psychological discipline to wait for it, to completely ignore one-year momentum trends, and to trust in fundamental value over the long haul. So I'll leave you with this to chew on. Does your current portfolio strategy actually have the patience required to weather the storm and capture that true long-term growth? Keep learning, keep analyzing, and we'll see you in the next explainer.